Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a daily candle chart of the Invesco QQQ Trust, ticker symbol QQQ. This is the ETF that basically tracks the tech sector. And as I do each and every week, I leave my lines on the chart so you can see how the forecast worked out. Now, if you remember from last week's report, I drew my little blue crayon lines up to the 20-period moving average, and I said that Monday, possibly Tuesday, we would go up to the 20-period moving average and hit that as resistance, and I drew that little R representing resistance, and then I said we would most likely pull back from that point. And that's exactly what happened. Now, I will admit here, I did not expect that big of a sell-off on Tuesday with the shock of the CPI numbers coming in so hot. But the good news is we did hit that downside target. We did that precisely today. That's that green dotted line representing the gap fill point. And now that we've hit all targets, I could erase these lines and then redraw what I think we'll see for next week. Now, understand that most of what I'm saying here will apply to the rest of the major markets. And you could see that now that this gap has filled, I have a gap fill rule that 80% of the time gaps fill, and then 80% of the time after gaps fill, we tend to reverse. Now, we gap down today, and we still have this gap above the market will most likely act as a price magnet. Now, I don't think we're going to get all the way up to that level on Monday or Tuesday, but I do believe that we are going to move up to fill the gap Monday and Tuesday, and then all bets are going to be off as we wait for Fed announcements on Wednesday. Now, there's three different scenarios that we could be faced with on Wednesday. First one is that the Fed comes in and raises, as expected, 75 basis points. At that point, we might see a relief rally from the market, being that we came in as expected. So that could result in a rally on Wednesday. Second scenario is because of the hot CPI numbers, the Fed comes in and raises by a full percentage point, at which time I do believe that will shock the market lower. We could even see the Dow drop by 2,000 points on that day should that happen. The third scenario is that the Fed comes in with a 75 basis point hike as expected, but the tone of Powell following with comments that this may not be enough moving forward to get ahead of inflation based on the CPI numbers, at which time that could cause the market to drop once again. So 2 out of those 3 scenarios could result in a lower market next week. Now, again, with that said, I'm going to draw these very short forecast lines here. I do believe that we're going to rally up to fill the gap. And then if 2 of those 3 scenarios hit where we could go lower, I think we're going to go right back down the breakout below these lows from today. All right, so looking at the oscillators down below, the stochastics is starting to hinge up. The CCI is already oversold. I think that will pivot on Monday, possibly Tuesday, but this is the scenario for the Qs. Now, the same thing is what I'm going to say here for the diamonds. As you can see, it happened exactly as the same forecast as I had with the Qs. We went up to 20-period moving average, pivoted lower, and came right back down to fill the gap. So that gap fill target is filled. My target from last week, as you can see right here from this little zip line, 306.09. We closed a little bit above that, but we traded lower beneath it. And so that target is hit. Now I could erase all those lines as well and redraw pretty much the same scenario is what I expect to see in the Qs. So Monday, possibly Tuesday, a rally to fill that gap. We might see a drop in volume on Tuesday, and then I think we're going lower. I'm betting on the downside here because, as you will see from my slides, there's way more negative economic news than what we're seeing on the positive side. Now let's look at SPY. Again, same scenario. We went right up to that 20-period moving average, just like that, hit it, pivoted. Go back and listen to the recording for those who want to learn about technical analysis and how to read these candles. It's a good refresher. Go back, listen, and then look at the video from today and compare the candles so you can see how it played out. Now, SPY did not come down all the way to fill the gap. So as of now, we're still looking at an open gap below the market. And with that said, I'm going to erase this line and redraw. Again, a gap fill possibly on Monday, Tuesday, and then right back down eventually to fill that gap. Now look at my timeline. If you look at the date in the bottom right-hand corner of this box right here, you'll see that brings us out towards the end of September, September 26th. Don't count on the date all that much. It's the price action that I stress as being most important in the type of candle. All right. So for those option traders out there, I'm hoping you're having a great time. Our members are celebrating a day like today. Almost all of our positions, except for one, are making money. And the one that is losing is not even nearly losing what we've gained on the long side. So this is a really great market. If you're interested in learning how to trade options, just call Market Rebellion. That's all you have to do. Just go and you can sign up for one of our memberships where I put out trade alerts and you can just follow along with my videos as I track the positions. So that's our forecast for the spiders. Now I'm going to hop to the VIX and then I'm going to go to IWM. The VIX, as you can see right here, I had my upside target set at that green line right there at 28.61. We came within 12 cents of hitting that target, 12 cents. I'm going to call that close enough for a target, but eventually we'll get back over that. But for the short term, here's what I think we're going to see in the VIX. Let me erase that line first. I'm going to erase this line right here. I'm going to erase this line back here. I have a longer term target on the VIX that I'll show you in a minute. But looking at that candle, we have a long shadow above that candle, very close to what's known as a shooting star. It's not quite a shooting star, and it's not quite a bearish engulfing. It would have had to go a little bit lower for that to be bearish engulfing. But for next week, I think the VIX is going to drop to that 20-period moving average and then go right up and start to break out over this high. Now, what I was saying before, I have a longer term target that is fallen off the chart because it's up here at 41.88. I actually have that drawn back here. Look at that little box, 41.88. I do believe we will hit that as a longer term target for the VIX. Option traders, take note of that. This is an opportunity for us when the VIX starts to go up to roll our positions, take in more cash. Those who don't trade options have no idea what I just said, but this is a great time for option traders. And again, they are celebrating this particular market, especially on the downside. All right, so that is the VIX forecast. I think we're going to eventually go up to 29.12 after we bounce off that moving average. Now, IWM is the only one that has not come close to hitting that downside target. Now, I'm going to keep that line in place because look what we have here. Very close to a hammer pattern right there, which is bullish. We had a drop in volume yesterday, not today. We had a drop in volume yesterday that was bullish because a drop on the way down is bullish, drop in volume, that is. We have a hinge forming, a slight hinge on the stochastics, and we have a positive divergence on the CCI. Look at that. If you look back here, we had a low that correlates to this low on the CCI. We now have a lower price low on that hammer pattern with a higher low on the CCI. That's a positive divergence. So we will see a slight rally, I believe, to fill that gap. And then I'm going to go further out in time for that target to be filled at that support level right there around 168.42. Now, let me give you some news here that's come out this week that some of you may not have seen. Let me start at the top here. If you look, credit card study came out, and this came out on Monday. Look at the amount of debt that consumers are taking on. 86.2 billion in new credit card debt. That's absolutely incredible. To put this on a chart, this is what it's looking like. Prior to the crash of 2008, we saw credit card levels at record highs right here. Now, this came out earlier last week, and this is approaching all-time record high in consumer debt. I do believe that this is now surpassed that, and we are at all-time record levels. What does that look like on another type of chart? Well, here, just give you a little bit of a refresher on what happened back in the crash of 2020, the COVID crash. Back in the crash, when everyone was locked down, what was happening? Their savings were going up Why? Because they were locked down in their house. They couldn't go out to dinner. They weren't spending money. As a result, their credit card debt came down because, again, they were not spending money. They were locked down. Look what's happened recently right here. 2021 was the big cross. Consumer debt in the use of credit cards right here has gone up dramatically. It's skyrocketed while savings have dropped to a new low. What does that mean? Think about that for a second. As savings accounts are being depleted because people have to pay the bills, they're now using their credit cards to pay the bills. It's sad, but that's exactly what's happening, and that's what that chart is showing. Right before any bubbles are to burst, this is what you usually see. You see increase in debt and drop in savings. This is one of the things that's causing some of the problems. You can see the CEO of Verizon came out and said that their subscriberships are declining. People can't even pay their wireless cell phone bills, and they're using credit cards to pay for that. A lot of people are not. Maybe you wouldn't do that. I certainly wouldn't do that. My kids wouldn't do that. But a lot of people do that because they're living week to week, not even month to month. Here's one that's a little secret that the trucking companies won't tell you. Some of you know this already. Years ago when I was in Wall Street, I bankrolled a trucking company called Red Line Trucking. My brother-in-law actually ran the company. But there's a term that's used, deadhead mileage. I don't know if you could see this right here. Deadhead mileage. What is that? Now, we're seeing this in Europe right now, but it's working its way into the U.S. market. Deadhead mileage is when you have a truck that goes from point A to point B with cargo. And the way the computers work is that point B over here, you should be picking up another load to bring it back to your original destination. And these trucks are going back empty, zero income, and it's costing them. It's negative dollars. They're burning fuel with no cargo. This is on the rise and something that you have to keep in mind, because as we see these added expenses being passed into products that we buy because of shipping costs, we see inflation down the road. Again, these trucking companies don't pay the cost. They pass it through to us, the end line consumer. Look at this one right here. The CEO of Chevron warns Americans, here's the key word, to brace for higher natural gas prices. I'm going to get to that in a little bit, but as gas prices and energy prices go up, that accelerates the inflationary curve. And as I mentioned 2 weeks ago, we are bullish in the energy sector, and we continue to hold a bullish stance on stocks like Chevron, ExxonMobil, some of the ETFs like OIH and such. And we have positions in ExxonMobil that are doing very well right now as well. So again, call Market Rebellion if you're interested in getting some of those trade ideas. Here's something that you have to understand. I'm talking about this not from a political standpoint, but I'm pointing out one of the biggest blunders that could ever be made, where the White House has announced that they will begin to refill the emergency oil reserve when crude oil drops to $40 a barrel. Well, as any institutional trader will tell you, or even day trader will tell you, you never disclose your trade intentions. You never tell someone where you're a buyer. Why? Because if crude oil drops to $80 a barrel, everyone knows now that the government is going to buy oil at that price. So institutions will go in there and they'll say, oh, look at that. Oil's dropping to $80 a barrel. I'm going to buy it at 81. Why? Because it's not going to drop below 80. The government has put a floor on that price, and they've capped the downside. Oh, isn't that interesting? So what does that do? It drives oil prices up. Big, big blunder. Someone should tell the Washington officials there that they just made a big mistake and they shouldn't do that again. But the cat's out of the bag. You can't put that one back, and that's the way it is. Now, if you look right here, next Wednesday could be the biggest rate hike in 40 years. I say brace yourself, because remember the three scenarios. 2 out of those 3 scenarios are going to be bearish. So prepare for that. If you're a long-term buy and hold investor, I would suggest that you use protective stops, possibly learn how to use options as a insurance policy against any long positions, and be prepared. Cash is actually a position. I still think cash is king. Even though inflation will take its toll on cash, I think it's better than being loaded up, as Jim Cramer would say, loaded up on stocks at this particular point in time. Here's something that's extremely interesting. This goes in line with what I was saying. as of earlier this week, there's a 47% chance that the odds of 100 basis point or 1 full percentage point hike is on the road. This is higher than it was earlier in the week. And you can see how Bloomberg reported this. This was a big spike in the odds of a higher rate hike. So again, this is leading me to believe that we could see lower prices by the end of next week. Here's something else that goes into more or less the credit markets, where Goldman is stating some problems in the Apple Card business. If you want to pause the video to read the comments there in the bullet points, go right ahead. I'm not going to read to you what you could read for yourself. Go right ahead. And that is something to consider. Now, this is very, very interesting. My son and his fiance are looking to buy their very first home. I basically suggested to them, I can't tell them what to do because they're old enough to make their own decisions, but they basically are looking, and I said, you might want to just be patient, put in some low ball offers, and you might get some bites. Don't be in a rush. All right, so what does this chart mean? The red line represents the drop in the buy price as it compares to the list price. So in other words, what that means is, let's say you have a house that's being listed for $325,000, right? Maybe last year, someone would have taken that price and maybe even bid it up past the list price, at which time, what was happening? We had prices going up over the list price. Now, houses are being sold for well below the asking price or the list price. So this is a bubble that is bursting in the real estate market, which in turn could work its way into the stock market, especially as interest rates go higher, because the cost of financing a home goes up, less buyers come into the market, and they have to make up for the added percentage on their mortgage by adjusting their buy price. So they're going to have to spend less money to buy that same house because the cost of owning that house is going up because of interest rates and the Fed. All right, now finally, this last slide here, got to show you this. Last week, go back and look at this. I'm going to slide this over, and I want to show you what we're seeing in SPY. Now, last week, I showed you the option open interest, and I was talking about how important it is, whether you trade options or not, to pay attention to what's happening in the options market. Now, again, last week, I was pointing out the 390 puts. All right, the 390 puts were showing open interest right there of 96,638. Let me just slide this over here. I'll do it this way to show you, to compare. This is the same option spreadsheet. Look what happened today and what's happened since last week. That 96,638 has now grown to 131,085 contracts open interest. Today alone, they added 38,000 more. So what's happening is that come Monday, this open interest is most likely to be 169,000, almost 170,000 open interest. That's tremendous volume. And see the jump from 96,000 to where it is right now. That is extremely bearish. Now, the other interesting thing that I want to point out to everyone is, as I get rid of this slide right here, I'm going to show you where the next biggest open interest is. 114,000 coming into today at the 375 strike, with 57,000 more options being bought. So that's going to put that over 170,000 open interest, which surpasses what we have here. So what does that mean? Well, I wrote a white paper years ago for the MTA talking about pin pressure. I discussed and proved the theory to be true that markets tend to gravitate to the strike prices that have the highest open interest. Now remember, right now, that 375 is going to be the highest open interest. What does that mean on the chart? Well, check this out. 375 is right at that support level. Now, if it breaks out below that level and below the June lows, watch out below. Phase 2 is in full force, and we could go a lot lower. Remember, my longer-term forecast for the general markets is that we are going to surpass, or at least match, the March 2020 lows. This is my forecast. You think that's impossible? Well, guess what? It's not. Look at stocks like Adobe and some of the others that are already at their 2020 lows. This is where my long-term forecast is going to be right here. I think that's where we're going to wind up in the spiders. The Qs, go look at the 2020 lows. The diamonds, all of them. I think we're going right back down. Now, we're going to zigzag in ABCD patterns along the way, but that is my most realistic support level, at which time we'll have to see what happens. Do we get a bounce or we go further down? We don't know yet. Way too early to call that one. So I'm going to wish each and every one of you a very great weekend. Not a good weekend, a great weekend. I'm heading off to Dallas for the RebelCon 2022. We're going to meet a lot of our clients out there. We're going to watch some NASCAR racing and have a great time in the suite that Market Rebellion is reserved. If you're out there, please make sure you step up. Introduce yourself so I could shake your hand. And with that, I'm going to wish you a great weekend. Take care. Bye-bye.
Hello, John Najarian here. If you want to trade like a rebel, if you want to party like a rebel, well, you got to come to RebelCon 2022. It's going to be in Dallas, Texas, at the fabulous Four Seasons Resort. We start the 21st of September, go until September 24th. It will be more fun and more live trading than we've ever done before. That's why it's called RebelCon 2022. We're going to have barbecues and double the amount of live trading. So if you want to book that now, make sure you do, because the guest speakers, as soon as we announce those, this thing's going to be sold out. It's going to be something you do not want to miss. Limited to 250 people. Sign up now for RebelCon 2022 at the Four Seasons in Dallas, Texas.
Welcome to the Rebellion.